Hey there, deep diver. Looks like we're both tackling this financial accounting study guide.
Absolutely. Let's break down those key concepts together and make sure you really grasp what's expected.
Awesome. So, Chapter 1, the framework for the preparation and presentation of financial statements. Sounds kind of official.
It is, kinda. Think of it like the rule book for how businesses talk about their money to the world.
So like a universal language for money talk.
Exactly. First up, gotta grasp the basics: assets, liabilities, and equity. The study guide really hits those definitions hard.
Okay, so assets, those are the things a company owns, right? Like cash, equipment, the building.
Right. Don't forget the intangible stuff, though, like patents or trademarks. Those are valuable, too. Then you've got liabilities, what the company owes.
Not loans and stuff.
Loans, unpaid bills, yeah, all that. Then equity, that's the owner's stake. What's left after you take out those liabilities?
Got it. Now, the study guide also mentions this reporting period thing.
Yeah, that's just the time frame the company's using for their statements. Could be a month, could be a year, like snapshots in time.
Not the whole history, just that specific period.
Precisely. And speaking of snapshots, Chapter 1 brings up these fundamental assumptions behind reporting.
Okay, yeah. Going concern, accrual basis, and materiality.
You got it. Going concern is a big one. It assumes the business will keep operating, in the foreseeable future.
That's a big assumption. What if the company's about to go bankrupt?
Well, then things get interesting. If there's doubt, it really affects how you view those assets and liabilities. Red flag for investors. And the study guide, it really wants you to spot those situations where going concern might be shaky.
Makes sense. What about accrual basis?
So that means we're recognizing revenue and expenses when they're earned or incurred, not just when the cash changes hands.
So not just about the cold hard cash, more about when things actually happen.
Precisely.
Yeah.
Like if a company sells on credit, they recognize that revenue at the sale, even if the cash comes later.
That seems way more accurate than just waiting for the money.
It gives a much better picture of performance. The study guide really pushes you to apply this to different situations, see how it affects those statements.
Got it. Okay, last one. Materiality.
Materiality is all about focusing on the stuff that matters, only disclosing info that could really influence decisions.
So like cutting out the noise, just the key takeaways.
Exactly. The study guide wants you to grasp how we determine what's material and why it's important.
Okay, so we've got those basic elements, reporting periods, and the big assumptions. What's next?
Well, Chapter 1 finishes up with financial instruments. These are the contracts that create financial assets and liabilities.
Like, loans.
Loans, bonds, even those simple invoices you send out, those are all financial instruments.
Huh. So even my little IOUs count.
Yep. The study guide stresses how important it is to understand how these are classified and measured. It all has a big impact on the company's position.
So we got to pay attention to the details of those contracts.
Absolutely. Now, ready to dive into sole proprietorships?
Hit me with it. What's the deal with these one-man shows?
Chapter 2, Financial Statements of a Sole Proprietorship. That's where we put those principles into practice. The simplest business structure, just one owner calling the shots.
Like my friend who does freelance design from her home office.
Exactly. Chapter 2 goes deep on the specific statements they use. Income statement, balance sheet, statement of changes in equity. You've probably heard those before, right?
Yeah, I think so, vaguely.
Income statement shows the profit over a period. Balance sheet is the snapshot of assets, liabilities, and equity at a point in time. And that statement of changes in equity, it's tracking how the owner's investment has changed over time.
Okay, so like a three-part financial story.
You got it. Chapter 2 also dives into adjustments, changes we make to the statements to make sure they show the true performance.
Adjustments, like what kind?
Think depreciation, bad debts, stuff like prepaid expenses. These can really change the profitability picture. The study guide gives you examples of these, wants you to calculate their impact.
So, got to pay attention to the fine print.
Always. Ready to move on to partnerships?
Yeah, let's do it. Two heads are better than one, right?
Well, sometimes. Chapter 3 is all about those financial statements of a partnership, when you've got two or more people running the show.
So like when two chefs open a restaurant together.
Exactly. Now, partnerships can be trickier than a sole proprietorship because you've got multiple owners, different contributions, different ways they split the profits.
That's where those partnership agreements come in, right?
Yeah.
The study guide really emphasizes those.
Absolutely. That agreement is like the rule book for how the business runs. Who gets what, how decisions are made, even how someone can leave the partnership.
Seems like a must-have to avoid future arguments.
For sure. And remember, each partner's bringing their own assets, liabilities, expertise. The study guide's big on tracking each partner's individual capital and current accounts.
So it's like everyone's got their own mini balance sheet within the partnership.
Yep, you got it. And of course, Chapter 3 covers the financial statements for the partnership as a whole.
So we're building on what we learned before.
Exactly. Now, ready to shake things up a bit.
Always up for a challenge. What do we got?
Chapter 4. Changes in the ownership structure of a partnership. We're talking about what happens when a new partner joins, or someone retires or leaves the partnership.
Oh, so like the band breaks up or they add a new drummer.
It definitely gets more complex. The study guide really focuses on being able to calculate new profit-sharing ratios when these ownership changes happen. You also have to know how to adjust the partner's capital accounts and show those changes in the statements.
So it's like a financial puzzle. Got to keep everything balanced even when the pieces change.
You got it. And these changes, they have legal and financial implications. The study guide hits on both sides of that.
Okay, got to think big picture, all the moving parts.
Now ready for the final frontier of partnerships.
Hit me with it. What's the end game?
Chapter 5. Liquidation of a partnership. We're talking about ending the partnership.
Ah, so like the band officially calls it quits, sells all their gear.
Exactly. Liquidation happens for all sorts of reasons. Could be the partners want to go their separate ways, the business is struggling, or maybe it's just run its course.
So what happens to all this stuff, the assets and debts, when they liquidate?
That's what Chapter 5 breaks down. The study guide wants you to get those different methods of liquidation, selling everything at once, or a more piecemeal approach. And you got to know how to distribute whatever's left to the partners and settle any debts.
Seems like a delicate process.
It is. Lots of planning and attention to detail. The study guide emphasizes understanding how the partner's capital accounts are affected during this whole thing.
Right. Each partner has their stake.
Mm-hmm.
Got to make sure it's divided fairly.
Exactly. Now, ready to shift gears a bit, let's talk about close corporations.
Okay, close corporations. What are those all about?
Chapter 6, Financial Statements of a Close Corporation. These are a kind of unique beast.
From the study guide, it seems like they're somewhere between a partnership and a company.
That's a good way to put it. They've got some of the benefits of both. Limited liability, like a company, but a simpler structure, more like a partnership.
So what are the key things to know about them?
The study guide highlights understanding their special features. Things like membership requirements, the founder's statement, and the whole concept of limited liability.
Limited liability, that means the owners are protected, right? Even if the business goes under.
Exactly. Their personal assets are safe from creditors. That peace of mind is a big draw for a lot of entrepreneurs.
Makes sense. What about the financial statements for close corporations? Anything special there?
They're similar to partnerships, but with some key differences. The study guide focuses on preparing those statements specifically for close corporations, taking those unique characteristics into account.
Okay, so we're adding another layer of expertise here.
Precisely. Now, ready for the big leagues.
Bring it on. Let's talk about those big companies.
All right, deep diver, welcome to the world of companies. Get ready, things are about to get a bit more complex.
I'm a little intimidated, not going to lie. Chapter 7 in the study guide, Financial Statements of Companies. What makes companies so different?
Companies, they're a whole other ballgame. Lots of regulations like the Companies Act, which, by the way, the study guide says is a must-read. One of the biggest things is share capital. That's what really makes companies unique.
Share capital. Is that connected to shareholders?
Absolutely. Shareholders, they're the investors, the ones who own a piece of the company. Share capital is how the company gets money from those investors, by issuing shares.
Okay, so it's the collective investment of all the shareholders. The study guide talks about different types of share capital, though. Authorized, issued, reserve capital? What's the difference?
So, authorized share capital, that's the maximum number of shares the company can issue. It's set out in their documents when they're formed. Issued share capital, that's the portion that's actually been given to shareholders. And then you've got reserve capital, this is set aside, can't be paid out as dividends.
So it's like different buckets of money, each with its own rules.
You got it. The study guide wants you to understand these different types and how they show up on the balance sheet.
Okay, that makes sense. Now, what about the shares themselves? The study guide mentions ordinary shares and preference shares.
Right. So ordinary shares, those are the most common. They give shareholders voting rights, and they can get dividends, a portion of the profits. Preference shares, they usually don't come with voting rights, but they get a fixed dividend, and they get paid first if the company liquidates.
So it's a trade-off. A say in how the company's run or a guaranteed payout?
Exactly. The study guide's big on understanding the rights that come with each type of share and being able to explain the differences.
Now, issuing shares. The study guide makes it sound kind of crazy. Applications, allotments, over-applications. Like a mad scramble for a piece of the pie.
It can be. Especially when a company goes public, that initial public offering everyone wants in. So the company sets a price for the shares, invites investors to apply. If more people want shares than there are available, that's an over-application.
So how do they decide who gets the shares if that happens?
That's where allotment schedules come in. The company needs a fair way to distribute the shares. Could be pro rata, a lottery, or a mix. The study guide gives examples of different situations, wants you to understand how it all works.
Sounds like a lot of math and planning.
It is, and sometimes companies use underwriters to help manage the whole process.
Underwriters, what do they do?
They're kind of like middlemen between the company and the investors. They often guarantee to buy any shares that the public doesn't subscribe for, make sure the company gets the money they need.
So they're like a safety net.
You got it. Now let's talk dividends, the fun part of being a shareholder.
Yeah, the payoff. The study guide mentions interim and final dividends. What's the difference there?
Interim dividends, those are paid during the year. Final dividends, they're declared at the end of the year after they know the profits. The study guide really stresses understanding how dividends are calculated and declared, taking into account those different share types and the company's dividend policy.
So it's not just splitting the profits evenly.
Nope, it's more complicated than that. Remember, companies can only pay dividends if they have enough money set aside, what they call distributable reserves. And they have to pass this solvency and liquidity test. Basically, making sure they can cover their debts and have enough cash to keep running.
Seems like a balancing act. Rewarding shareholders, but also making sure the company stays healthy.
Exactly. Now, another way companies raise money is through debentures.
Debentures, are those kind of like bonds?
You got it. Debentures are debt instruments. Companies use them to borrow money from investors. They usually have a fixed interest rate and a maturity date. The study guide wants you to know how they're different from shares and how they affect the company's financials.
So instead of selling ownership, they're taking out loans.
Precisely. And just like with any loan, gotta be careful with the terms and conditions. Balance the need for cash with the ability to repay.
Sounds like managing company finances is a strategic game.
It is. Now let's touch on the financial reporting requirements for companies. The study guide emphasizes the importance of understanding those statements they have to prepare.
We've talked about a few already, right? Income statement, balance sheet.
Yep, those are key. They also need a statement of changes in equity, shows how the owner's investment has changed over time.
That one sounds familiar from partnerships.
Right. And then there's the statement of cash flows, which we'll get to in Chapter 8. The study guide wants you to know the purpose of each of these statements and how to analyze them.
So, companies have a lot more paperwork than those smaller business structures.
They do. More stakeholders involved, shareholders, creditors, regulators, they all rely on this information.
It's like learning a secret code to understand company financials.
You could say that. Now, ready to tackle cash flow statements.
Let's do it. Chapter 8 in the study guide is Statement of Cash Flows. Why are these statements so important?
Cash flow statements, they tell a different story. They show the actual flow of cash in and out of the business, not just when the revenue and expenses are recognized.
So it's a more realistic view of the company's money situation.
It is. The study guide breaks down cash flows into three main categories: operating activities, investing activities, and financing activities.
Okay, I see those in the study guide. What exactly do they mean?
Operating activities, those are the core things the business does to make money. Selling products, providing services, managing their working capital. Investing activities, that's about buying and selling long-term assets like property and equipment. And financing activities, that's about how they raise and repay capital, issuing shares, taking out loans, paying dividends, that sort of thing.
So we're categorizing the different ways cash moves through the company.
Exactly. The study guide wants you to be able to classify those flows and understand what they mean for the company's overall health. It also talks about two ways to prepare the cash flows from operating activities: the direct method and the indirect method.
Yeah, I see both of those mentioned. What's the difference?
The direct method lists the cash inflows and outflows directly. Cash from customers, cash paid to suppliers, that sort of thing. The indirect method starts with net profit and then makes adjustments for things that don't involve cash.
So different ways to get to the same answer.
Precisely. Companies choose based on their preferences and what information they have available. Now, the study guide also talks about non-cash transactions. These are things that affect the financials but don't involve actual cash changing hands.
Non-cash transactions, like what?
Think depreciation, bad debts, revaluation of assets. They don't directly affect cash flow, but they can have an indirect impact.
Okay, so we need to be aware of those when we're looking at these statements.
Absolutely. The study guide highlights the importance of adjusting for those non-cash transactions when you're preparing the statement. It gives examples and wants you to analyze their impact.
Seems like cash flow statements are kind of a puzzle. Got to put all the pieces together to see the full picture.
They are. And remember, IAS 7, the accounting standard for these statements, it gives very specific guidance on how to classify and present everything. The study guide suggests getting familiar with the key principles of IAS 7.
Okay, so the study guide A&D, IAS 7. Got it. Ready for the last chapter.
Let's do it. This is where it all comes together.
All right, deep diver. Time to put on our analyst hats. We've covered the basics. Now let's dive into what those numbers really mean.
Chapter 9, the analysis and interpretation of financial statements. Sounds like we're going beyond just reading the statements.
Exactly. Financial statement analysis, it's about understanding the story those numbers tell, figuring out how healthy the company is, how they're performing, what their future looks like.
So we're like financial detectives.
You got it. And one of the best tools we have are ratios.
Yeah.
Chapter 9 spends a lot of time on those.
Ratios. Those always seem kind of confusing. What are they exactly?
Ratios, they're just comparisons between different parts of the financial statements. Help us standardize the data, make it easier to compare companies, or even see how one company's doing over time.
So it's like a level playing field for comparing companies.
Exactly. The study guide breaks them down into 4 groups: profitability, liquidity, solvency, and activity ratios. Each one focuses on a different aspect of the company's performance. Okay, let's start with profitability ratios. What are those all about?
Profitability ratios, they tell us how good the company is at making money, how efficiently they're using their resources, their assets, their sales to generate profit.
So like how well they turn inputs into profits.
Precisely. Some key ones the study guide mentions are return on equity, return on assets, gross profit percentage, profit margin. Each one gives a slightly different perspective on profitability.
Okay, so we can see how good they are at making money. What about liquidity ratios? What do those tell us?
Liquidity, that's all about short-term survival. Can the company pay its bills? Do they have enough cash or assets they can quickly turn into cash to meet those short-term obligations?
So it's like, can they keep the lights on?
Exactly. The study guide focuses on the current ratio and the acid test ratio. Current ratio compares current assets to current liabilities. Acid test ratio, it's a bit stricter, doesn't count inventory as a quick asset.
Okay, so those give us a quick check on their short-term health. Now, solvency ratios, those sound more long-term.
You got it. Solvency ratios, they look at the company's long-term financial stability. Can they handle their big debts? The ones that stretch out over years.
So can they weather those financial storms?
Exactly. 2 big ones here are the debt-to-equity ratio and the times interest earned ratio. Debt to equity compares their total debt to shareholder equity. Gives you an idea of how much they're relying on borrowed money, which can be risky.
Risky how?
Well, if profits drop, that debt can become a big problem. Now, times interest earned, that looks at whether they can cover their interest payments with their earnings. Higher ratio is better, means they've got more cushion.
Okay, so solvency is all about long-term survival. What about those activity ratios? They sound more like, I don't know, operational stuff.
You're right. Activity ratios, they tell us how well the company is using its assets to generate sales and manage its working capital. Basically, how efficiently they're running the day-to-day operations.
The study guide mentions a bunch. Inventory turnover, receivables, collection period, all that.
Right. Those are all about efficiency. Inventory turnover, for example, tells you how fast they're selling their inventory. Higher is better, means they're not sitting on a bunch of unsold stuff.
So activity ratios, they're like a peek behind the scenes, see how smoothly things are running.
Exactly. And remember, all these ratios, you have to look at them in context. What industry is the company in? What's the overall economy like? The study guide stresses that it's not just about the numbers themselves, but also about using your judgment and understanding the bigger picture.
So it's a mix of number crunching and like financial intuition.
Exactly. It's both an art and a science.
Well, I feel a lot more prepared to tackle financial statement analysis now. Thanks for walking me through it.
My pleasure. And remember, this is just the start. The world of finance is always changing, so keep learning and asking questions.
I definitely will. This deep dive has been amazing. I feel like I've unlocked a whole new understanding of financial statements and how to use them.
That's great to hear. Now go out there and use that knowledge. Whether you're investing, managing your own money, or just trying to understand the business world better, these principles will help you.
I'm excited to see where this knowledge takes me. Thanks again.
You're welcome. Until next time, happy analyzing.
And one last thought for you, deep diver. Now that you have a grasp of these financial statements, why not try applying them to your own finances? Could you create a personal balance sheet? Track your cash flow. It might give you a whole new perspective on your financial well-being. Until next time, happy deep diving.